The financial system came very, very, very close to collapse yesterday. I did a video recently about this not budget, mini budget thing, and to be quite frank, I think Parliament really just has to block it. It's going down. So, hi guys, we've got a lot to get through, but we're going to watch a couple of videos and then I'm going to take you through some data. So
I've just been kind of getting more.
This is a video by Politics Joe. They're kind of a left-wing YouTube channel, so they're a little bit biased, but the three people they've got in this video are not politically aligned. Okay.
Detail on precisely what was it that lay behind the bank's intervention, an incredibly unusual intervention for them to go in and start buying up specific government bonds because they noticed dysfunction in the market, essentially that part of the market not working. Well, what are the pragmatic consequences? What's the pragmatic story that lies beneath that? Well, I'm told that what they were responding to is what internally has been described as a run dynamic.
A run basically means people are pulling out money just so quickly that nobody can keep up. Like, essentially, a run is like in 2008, you had a run on the banks, and that caused Northern Rock to collapse. And that's an unfortunate pause moment, isn't it?
What does that mean?
Let's see if I can. There we go. He looks a bit more sensible now. I've just noticed my hair's a total mess, but I've been anyway. Yeah. So I mean, we'll see what really happened in a minute, but
it's very similar in kind of wholesale terms to what we saw with Northern Rock when there was that run on that bank back in 2007. It's a vicious cycle, essentially, people trying to withdraw money, which in turn leads sometimes inevitably to financial collapse. And I'm told
financial collapse. So that's what we're talking about. Like, it's not a collapse of banks; they're fine. It's a collapse in other. Now, I don't think this is entirely the mini budget. I think Andrew Bailey, who's the current governor of the Bank of England, has made some significant mistakes recently to try and tackle inflation. Again, go back to the other video I recorded about why this isn't inflation. And I think that the attitude of the Bank of England is wrong, because we're not seeing what you'd normally call inflation. I'll skip forward to the next guy so we don't spend too much time watching all this.
As an open economy, a large and increasing the budget deficit should push up the pound, as it did, for example,
this is true.
In the early years of the Reagan presidency. That's because the assumption is that an independent central bank will raise interest rates in order to attract money into the country to finance the budget deficit. Hence,
yeah, because if interest rates go up with the Bank of England, then your cash returns should go up. So it should make the pound a bit more attractive because you're going to earn more money,
pushing up the currency. So why did the pound initially fall? Well, that's what my former Treasury colleague Dario Perkins calls the quote moron risk premium unquote.
The morons here being the government, and that's what he basically goes on to explain, that essentially the financial institutions across the world think that our government is utterly incompetent and they don't trust it at all.
Markets drop, the housing market's in trouble, and you created a giant recession because the Bank of England has to raise rates. Your credibility is completely trashed. And what's the Prime Minister going to say? Well, at the moment, she appears to be hiding. But the questions that journalists like you and Ian King and everybody else and Ed Conway and others are going to ask is, so what are you going to do? It's all completely failed, hasn't it? They told you it was going to fail, and it has. Now what are you going to do? And obviously the question then is, politically, does she survive the month? Does she actually get to, and does he get to, this statement in 2 months' time? Because presumably...
So there's this thing in the Conservative Party called the 1922 Committee. What it can do is remove the Conservative leader. Letters have already gone in to Mr. Brady, I think his surname is, who's the chair of this committee. Those letters mean that people have already said, we want Liz gone. She's literally been in post like weeks, and Thanks to Kwasi Kwarteng and Andrew Bailey, and we'll come on to that in a second, she might be out of a job already. Now, this doesn't look good, and I don't like to go back to the B word, but I think the specific flavour of Brexit that Johnson introduced us to has caused this kind of mindset where, you remember Michael Gove saying we don't trust experts anymore? Well, the experts did tell her this is a bad idea. We know that the advice she's received and Kwasi Kwarteng has received is this is not a good idea. It will not work, and it might cause difficulties, and it is causing difficulties. So much so that the Bank of England has had to reverse its decision. Now, more on that in a second. I just want to go to Yanis Varoufakis, who's the whereabouts do I want to start this? Maybe at the start, or I can't remember when he said what the interesting bit.
Debt crisis. Britain is not Greece. It's not Argentina. You issue the currency in which you borrow. And that means that you are never going to have the problems that Greece had or Argentina did. But this is an interest rate crisis.
So what he means by that is that because we issue our own currency and we borrow in that currency, Argentina and Greece, they were affected by external factors, exogenous factors, you could say. That essentially tanked their economy. They were kind of a victim of a pretty terrible economic situation. Whereas that's not us. I mean, we are. Hold on, let's turn my mic up a little bit because it's not. Yeah, there we go. We are able to withstand these shocks, so it shouldn't really be a problem for us. He does go on to do the typical Yanis Varoufakis thing of talking around the shop and not really saying anything. So I'll leave that bit there. This is a really good explainer, actually. We've got like 5 minutes of this. That's
intervention. The Bank of England announced today it will buy unlimited quantities of government bonds at a, quote, urgent pace. Action carried out.
The United Kingdom is a successful economy.
That was the Prime Minister on Friday, backing the tax cuts her Chancellor had just announced, which prompted fear in the markets. Today, from the Prime Minister and her Chancellor, silence. From the business
nobody's talking. Really weird. The government shut down.
Silence.
We got the Tory Party conference
starting
this weekend.
And silence from the Chief Secretary to the Treasury.
Do you think that the Chancellor is fit to continue the role?
But we did get this defence from the Financial Secretary to the Treasury, Andrew Griffith.
For a lot of people, they're looking at what's happening in financial markets, and they see a storm, that started with that fiscal statement last Friday. Do you not take responsibility for that?
No, we both know that we're seeing the same impacts of Putin's war in Ukraine cascading through things like the cost of energy, some of the supply side implications of that, and that's impacting every major economy. And just the same, every major economy, you're seeing interest rates going up as well. So as we go,
not to the same degree as in the UK.
Every major economy is dealing with exactly these same issues.
That's an argument that doesn't stack up, says the Labour leader.
This is self-inflicted. This was made in Downing Street last Friday. And for what? For uncosted tax breaks for those earning hundreds of thousands of pounds. And so what the government needs to do now is recall Parliament and abandon this budget before...
Yeah, Keir's playing a little bit of politics here because he knows they won't recall Parliament because it's the Conservative Party conference. Now, as an ex-Tory, the Conservative Party conference is where an awful lot of fundraising for the Conservative Party happens. So they're not going to abandon that. That's basically going to secure their funding for the next goodness knows how long. So he knows that's not going to happen. But ultimately, he is kind of right in that they do need to scrap this and have another go.
Any more damage is done.
We don't know what the market's going to do. That's what we're saying, basically, on that.
Uneasy investors had been demanding huge interest rates in order to lend to the government through bonds, which sparked fears of major interest rate rises for us all.
Yeah, I'm just going to skip over this bit because this bit's about like mortgages, and some mortgage providers have stopped trading. Although there was a guy from some mortgage company who was on Sky the other day saying, no, there's absolutely no problem whatsoever and we support this budget, which is a bit weird because why would a mortgage company be supporting a budget? I know, like I said, landlords are set to benefit, so maybe they've got a lot of landlord clients, but it's a bit of a weird thing to be saying.
It's very bad. A core part of Britain's financial system effectively stopped working in the space of a few hours, and the Bank of England felt it had to intervene to stop the shockwaves spreading out to the rest of the economy. Now, the question tonight is, of course, is this intervention working? And we can look for evidence of this by looking at the interest rate that the government is having to pay on some of its borrowing.
For now.
So if we look here at the interest rate on the government borrowing over 30 years, you can see last week it was 3.5%. It shot all the way up to 5% this morning after the budget. And then when the bank intervened today, you could...
So this chart's a bit weird. I'm pointing at the screen, and obviously you can't see my pointer. You can see, I need to get a bigger mouse or something for this video now. This is since Thursday, so this is the 30-year rate. I've got this here so you can see it a bit better. This is the 30-year rate since 1998. So essentially, these are 30-year bonds that the government have issued. So essentially, the government have said, well, we'll pay you a coupon of X percent every single year, i.e. an interest payment every single year for the next 30 years, and at the end of the 30 years you get 100 quid back per bond. Okay, this is how they work. They are tradable though, so you can buy and sell them, so that future income is priced in, as it were. So 30 year though, that's a very long bond. These are kind of the more higher risk bonds in issue, so they tend to be the higher return. Basically here you've got all the different maturities, so you've got 1 month, 3 months, 6 months. This yield should be increasing as you go down, so it sort of is, but there's a bit of a price inversion here, so there's a bit of a hump around 3 to 5 years. That's not normal. Normally you just see steadily rising, so people don't trust the long-term viability of UK debt. So 30 years, look at it's lower, much lower than 5 years. So the markets are saying basically in 30 years we think the UK is less financially stable over 30 years than it is over 5 years. That's basically what this is saying. Yields going up is bad for people who hold bonds. So if I get my other chart, here we go. This is a typical gilt tracker over I think over the last month. Here we go. So over the last month, so everything was gradually sliding down. I mean, a 10% loss in gilts is awful anyway, and then we come to since Friday it's dropped a further like 20%. I mean, that's big, and here's why. So if this is the Pension Protection Fund website, this is essentially these are the people who, if a final salary fails, i.e. is massively underfunded, and the sponsoring employer goes bust, then the government step in and underwrite the pension. And the PPF is that person. They take the assets of the scheme, they invest those assets, and then they essentially pay out to people. So they kind of guarantee at most 90% of your final salary, at most. This is their asset allocation. Okay, so they will have tens of billions of pounds invested, okay, of an underwriting and guaranteeing a lot of people's essentially final salaries. And the way they invest money is pretty typical and pretty indicative of an average asset allocation for a final salary scheme. 40% is in gilts, pretty much. They've got some corporate bonds, but there will be a big chunk in gilts, even if gilts is half of that. So if you're running a final salary scheme or any kind of pension fund, you're going to have some allocation to gilts. if you've just lost 6-7% of your fund because the safe bit, gilts are supposed to be the safe bit. You see, the thing is, when you put together an asset allocation, this bit, so equities, what we call alternative, they call hybrid. Normally they're called alternative. Oh, they mean hedge funds. Okay, so hybrid assets, they mean hedge funds. Alternatives are in here. Farmland and timberland, absolute return strategies are hedge funds. I don't understand the difference between the two then. I don't understand the difference between the two. They seem to be the same thing. Anyway, but this is the at-risk bit. So you expect this, this sort of 50-ish% of the portfolio. You expect that to be volatile. These bits are supposed to be safe and kind of shore up the value. So this collapse, this total collapse in gilt values, is causing significant problems. So much so that lots of institutions, had the bank not intervened, would have gone bust. Sorry, I got a bit of a cold.
You can see it drop back down to 4%, and that is being viewed as evidence that the bank is being successful in stabilising this market.
So why doesn't the bank do more to bring interest rates down?
Well, the thing is that what it's doing doesn't necessarily mean that it wants to bring interest rates down, even though that would be welcome, no doubt, for many people with a mortgage. Some economists today interpreted this as evidence that the bank felt that financial markets were getting a bit out of control, that interest rate expectations were too high. They wanted to lower them.
They are, because we're not going through a period of inflation.
The bank has been very clear today, no.
What I mean by that is that inflation is just like, that's an economic policy that's normally in the UK in the hands of the Bank of England, and what they're essentially trying to do is make sure that asset prices inflate a little bit every year to stop prices going downwards, so that essentially everybody gets paid a little bit more every year, prices go up every year. And what they do is they just gradually increase the amount of money in circulation, and that increases the prices of things because there's more supply of money, and therefore everything gets slightly more expensive. The opposite to that is prices going down, and then people hold off spending money, and you end up with a depression. So prices going down is incredibly bad for the economy. So you want prices to trickle upwards at like 1-2% a year, just to make sure that you end up avoiding a depression. Okay, that's the kind of the economic theory. If inflation's too high, normally that means that we're increasing monetary supply too much. That's not what's happened here. This isn't inflation. This is an asset price spike. Inflation will be fine next year because, inflation was sort of normal. Then oil prices went up. And then by the time we get to next year, it'll be normal again. So increasing interest rates because the oil prices have gone up, and there's rampant profiteering across pretty much everybody in the energy sector. That's not a good idea. It's not going to work. And Andrew Bailey will have been told this. His predecessor, Mervyn King, not his predecessor, sorry, that was Mark Carney, but Mark Carney's predecessor, Mervyn King, also went through a similar thing in that inflation was quite high, but that wasn't because of anything to do with the bank, of what the bank was doing. And so he used to write to the Chancellor frequently, George Osborne, saying, yes, inflation's a bit high, but that's not caused by anything under our control. It's not caused by us, so we're not going to do anything. And that would be perfectly acceptable for Mr. Bailey to say. So we've talked about government bonds, we've been through the videos, we've done a bit of that, we've talked about the asset allocation. Yeah. Okay. So who is Andrew Bailey, and why do I think he's made a bit of a cock-up? Well, one of the things he's done recently is he stopped... You saw the announcements that they are buying gilts in an unlimited quantity. Only a few months ago, because of inflation, Andrew stopped buying government bonds, which... I said at the time that was dumb because it's not going to, that's not going to help things. I mean, that does need to be tightened a little bit because quantitative easing is bad in the long run and we need to get off it. But he did that and he put up rates at the same time, which I think caused, well, if you go a bit more long term to when he started doing this, so let's go 6 months, that covers the whole period. If you go a bit more long term, when it loads, yeah, here we go. So the gilt price, over the last 6 months has dropped 25% anyway. I mean, dropping 20% in the space of a few days, that causes problems. This you can manage. These massive shocks, I mean, in equities you can manage, in stocks and shares you can manage, in gilts it's quite difficult because, like I said in my last video, where do you go? What do you do with it? You just put it in cash, but cash has just fallen in value as well. So it's like, well, what are we doing? But this is pretty much ever since Andrew started not buying them. The value's tailed off by about 25%. That first 25% of losses, that's Andrew Bailey's fault. So who is Andrew Bailey? This is The Guardian. It's left-wing propaganda. I'd put this newspaper in that category. Sorry, any Guardian fans, but, it's kind of your version of The Telegraph on the left. So they're both extreme papers. They're both broadsheets, but they're quite partisan. So we'll take it with a pinch of salt. But then I've done a quick Google search that shows that it's not really partisan. I think this is a fair comment, though. This is what I'm saying. It was not long before he was accused of making missteps. Andrew Bailey went to Queen's College, Cambridge, and therefore, at 18, would have been a perfectly impressive young chap, and is probably very well spoken and has the appearance of being very bright. Now, we've seen quite a lot of Cantabrians and Oxonians recently not do clever things. Let's put it there. That it is not a guarantee of intellect or aptitude. However, it's an indication that at age 18 these people were very impressive, but have they kept developing their skills and sharpening the saw, as it were, over their lifetime? Maybe not. Andrew Bailey did history and then did a master's at history, then got a job at the London School of Economics as a researcher with a master's in history, and then ended up getting a job in regulation, and then ended up being chair of the Financial Conduct Authority. And all the disclosures that are coming out now, all the evidence that's coming out about conduct within the FCA when he was in charge, basically shows that he was asleep at the wheel. He was not a leader, not a manager, and the regulator was a total mess when he was there. There were staff members defecating in the corridors in the offices and getting away with it. He's that boss, right? So now he's in charge of the economy, pretty much. It's not going to go well, but why these people keep getting appointed to such important positions, I don't know. Mark Carney was, although he didn't like Brexit because it was going to cause damage to the economy, and got accused of being political, he wasn't really. Mervyn King was awesome, very, very competent. Anyway, yes. Where is it? Yes. So Bailey ditched his predecessor's policy of giving forward guidance to the financial markets. This was essentially this was like broadcasting confidence. He decided, I can't be bothered to do that. That looks like too much work. Which, Carney's forward guidance, and Mervyn King did, much the same. They just provide projections of what they think the economy is going to do, what they think interest rates and inflation is going to look like in the next 1, 3, 5 years, and that gives markets like gilt markets an idea as to, well, what should prices be. You ditch that, and then you lose the ability to forward price gilts. He said workers should restrain their pay demands to help bring down inflation. Well, again, this theory that it's because pay inflation is going up that's causing this other again, he doesn't seem to understand that it's not inflation, and he's supposed to be the expert. Yeah, this is as a result of global supply bottlenecks, rocketing energy prices. That's what's caused the inflation stats, which is a measure of inflation, but that doesn't mean that all it's measuring is inflation. It's also measuring the increase in prices. So the consumer prices index or the retail prices index, that measures how much prices have gone up. That's not a measure of inflation. Inflation, like I said, is that kind of monetary expansion within a central bank that just allows you to avoid a depression, which is a good thing. What he should be doing, what Bailey should be doing, is calculating, well, what is our rate of inflation? What's the bank's impact on inflation? Is that reasonable? He's decided not to do that, and he's just decided to look at the headline rate and say, well, that's a bit high. I should be hitting 2%, so I'm going to interest rate because we need to get it down to 2%. And that's stupid. But anyway, and then he stopped buying gilts, and he stopped quantitative easing because he's never liked it. But, I don't think anybody's ever liked it. The point is it's necessary. Nobody likes no doctor likes amputating limbs. Well, shouldn't like amputating limbs, but sometimes you have to do it, so and again, there was one comment here which I thought was absolutely, here we go, he might have been a bit too laid back for his critics who accused Bailey of being asleep at the wheel as inflation reaches levels not seen in 4 decades and the economy heads for a 5-quarter recession. So I just Googled Andrew Bailey asleep at meetings. So I remember reading a headline. And, the British Steel workers, where they all got essentially ripped off by, sadly, financial advisors. And they all got, quite a lot of them got inappropriately advised to move out of their final salary pension. Andrew Bailey, who was the chief of the FCA at the time, had a meeting with British Steel pension trustees and fell asleep in the meeting. Such was his level of attention during essentially talks to how on earth do we stop people from being missold a final salary transfer. He's been asleep at the wheel pretty much his entire career. From my experience of working with the FCA and seeing regulation change over the years, it's been terribly laissez-faire and utterly ineffective, pretty much. Especially at regulating the big things. So, what else was I going to say? What else was I going to talk about? No, it's all gone. No, I think that's about it, really. But, we're in really, really choppy waters. I don't expect this spring statement mini budget thing to go through. I don't even think it'll get through the House of Commons. I think there'll be enough Tory rebels to kill it. And even if it does go through the House of Commons, it shouldn't get through the House of Lords. And here's why. Because our Constitution is set up so that the House of Lords, basically, their job is to make sure that whatever policies the government pass, there's a public mandate for it. That's their job. There's to scrutinise legislation that the House of Commons has passed to make sure that the public have given the government the mandate to go ahead with this. So that basically is, well, okay, if it's something in your manifesto, fine. Yeah, you can do that. We'll let that sail through. So typically, if the Conservative government do something, or the Labour and Lib Dem and cross-party peers in the House of Lords, as long as it's in the Conservative manifesto and what the Conservatives have passed is more or less aligned with that, then they should just sail through. They should abstain and let the Conservative Lords vote in favour of passing this legislation. Because so essentially in the UK, House of Commons passes a bit of legislation, sort of. Then it goes to the Lords for them to also pass. So they're like a check and balance, and then it goes to the Queen for, well, now the King, sorry, for him to sign, and then it becomes law. So this has to be blocked because none of the promises in this not budget are within the Conservative manifesto. They have zero public mandate for it. So it has to get blocked, and Liz Truss has to call a general election. What does this mean for your money? Well, if you've got gilts, I'm sorry, but the value's just gone down quite a bit. And I've seen that over, the last week within, my clients' portfolios, and it's horrendous. Like it's unnecessary. That's the key word I'd use. Anyway, this video is half an hour long already. I think I've covered off everything I want to, and I hope this has been useful. If it has, please like, share, subscribe, all those things. I hate saying that. I wish there was a better, less salesy way of saying it. But anyway, do all that, and I'll see you soon.